Kathleen saying that the jobs report is still important. Is it, given that the Fed has already indicated peak rate is near?
Well, I think it's still important because I think there is a disparity between what the market is expecting and what the Fed is saying. The Fed is saying that you keep rates, you raise rates and keep rates higher for longer. The market is agreeing with the Fed with the Fed in terms of the rate hike for the next month, but the market is expecting a rate cut in the second half of this year. And I think the job report is important in that the numbers are still showing that the job market is still running too hot for the Fed's comfort, and it's likely that the Fed may have to push back harder against market expectations of rate cut. And this is why the decline in the dollar that we're seeing right now, that we're seeing in a very rapid decline since October last year, it might slow down as the Fed push harder against the rate cut imagination.
Some are looking very closely to what the ECB and the BOE are doing, and the pair they're watching is euro-dollar. Some say that 112 is in sight. What are you anticipating?
Well, I think we might be in a bit of a range-bound market as well. I mean, I think there was a notion, there was a thinking here that ECB would sound hawkish. At the policy meeting, it did flag for a further hike of 50 basis points in the March meeting. But, Christine Lagarde sounds quite non-committal on further hikes, after March. And that is why the euro has been under a bit of a downward pressure. I think in the medium term, there's still room for upside in the euro-dollar, partly because of dollar weakness, partly because of improving growth picture in the Eurozone as a result of lower natural gas prices. But in the near term, I would think that there is scope for some dollar pullback or a retracement of the euro-dollar rise, given that the rise has been quite rapid, a bit too fast, too far in the near term.
Moh, okay. It seems that everybody's on the dollar bear sort of bandwagon right now, and you are in part too. But what could change that?
Well, I think if we do get the risk here is that if we have disinflation, but disinflation gets stuck at around 4%, and the Fed that would make the Fed really uncomfortable, and the Fed may have to push back harder. In terms of not just keeping it high for longer, but perhaps seeing the need for further hikes to cool the job market down, to cool the economy down, to get inflation back to target. Then we could have potentially a case where we might see a more extended rebound in the US dollar.
And how far do you think that the dollar weakness that we've been seeing of late, in the last few months, has really been responsible for some of the equity euphoria that we've been witnessing, particularly in this part of the world?
Yeah, I think pretty much they go hand in hand in terms of the dollar tends to weaken as the equity markets rally. This is because risk-on tends to undermine the safe haven role of the US dollar. So in this part of the world, we have the big story here will be the China reopening, and that has contributed to appreciation of the Chinese currency, and that in turn spill over into the rest of the Asian currencies, and hence the dollar weakness that we have seen so far since the reopening momentum back in November last year.